Thank you for attending today's webinar. My name is Dean Christians, and I'm one of the senior research analysts at Sentiment Trader, joined by my colleague, Jay Kaeppel. If you're a new subscriber, please watch some of the previous webinars, as they will provide more insight into our research and analytical tools on the website. Today's webinar aims to introduce subscribers to our new trend and relative trend score composites. These indicators address long-standing feedback from clients seeking more actionable stock and ETF ideas. Our walkthrough will guide you through the website to access these indicators effectively, highlighting key features, settings, and real-world examples of systems and signals. Before we dive in, let's talk about the pros and cons of trend following. Okay, so pros of trend following. Well, it's very simple. If security ABC is above its 200-day moving average, you're long that security. If it's below that average, you're out of that security. So it's very straightforward entry and exit signals. It can be systematized. It's well suited for automation. It's simple. It can be systematized with buy and sell entry signals. It can capture large moves. There's diversification benefits. It can be applied to different, asset classes, stocks, commodities, currencies, and it's adaptable across different time frames. So you can use short, medium, and long-term trends. Cons of trend following would be that, of course, they lag. Moving averages lag price. So, this can lead to late entries and late exits, and you're susceptible to risk of a late trend reversal. Sideways markets, tend to, or choppy markets tend to, create a lot of signals. And so trend following systems get eaten up in a sideways market. And of course, drawdowns, depending on sort of the duration that you use for a trend following system, the longer in duration, obviously, the longer it takes to get out, or, the longer it takes to get in. And so they're susceptible to drawdowns. And then, of course, psychological, you always have to have the discipline to follow your trend following system. When you don't have that discipline, then you're susceptible to, confidence, and that's always a bad thing when it comes to trend following. Jay, do you want to add just a couple of things or talk a little bit about trend following from your perspective?
Yeah, absolutely. I think it's probably the best way to approach the markets, because typically things move in big waves, especially the stock market. So you're more likely to catch a big move if you're using some kind of trend following. I kind of like to use it as a filter. In other words, to tell me which direction to be looking. One thing that's really difficult, I know people who have tried it, is trying to be 100% in or out based on trend following. That's where people really get into trouble with trend following. So you're long one day 100%, and the market just ticks enough lower to trigger your sell, and all of a sudden you're 100% in cash. A lot of people aren't really set up psychologically to do that. And then if the market turns around and starts roaring higher, you have to have, as you mentioned, Dean, the discipline to get back in. So it's great as a filter. It's very important as a tool. As a mechanical thing with 100% of your capital, it's challenging psychologically.
Yeah. If you take away just one thing from today about trend following, is it's, simple fact is if you are a trend follower, you're never going to miss an up move as long as you stay disciplined to the system. And that's really key. There's a couple quotes that, that I've used over the years and related to trend following and momentum and relative strength. And I wanted to share those today. And I'm going to just sort of read through the first one and then a portion of the second one. But the first one's from Ned Davis. And here's what it says. Price is a unique variable. Unlike valuation metrics and economic fundamentals, which all have the potential to diverge from the market's primary trend, price is unique in that it cannot diverge from itself. As a result, price momentum systems attempt to lock onto major leadership trends, allowing profits to run and losses to be cut short, an essential principle of good money management. That summarizes trend following and relative trend following really well. The second quote, which is unknown, I found this online years ago. I'm not going to read the whole thing, but I'll just read a few of the important points. And markets are risky, and risk, everyone knows, involves loss or the possibility of loss going down. But rising markets are risky too. Regardless of how well a stock defends against loss during falling markets, if it does not score gains as the market rises, the trader is subjected to another risk, loss opportunity. Because the probability of opportunity loss is greatest when the broad list advances. The stock's offensive qualities are best measured when the market is rising. As we all know, markets generally trend up over the long haul, right? You're going to have more bull markets than bear markets. The bull markets are going to last significantly longer than the bear markets. And when you're in a bull market, you want to own the leaders. That's what trend/momentum, relative strength is all about. Okay, now that we've covered trend following, let's jump on over to the website and discuss the absolute and relative trend scores. I'm really excited that we've got these on the website. We're going to continue to add and make improvements to what we see on the website: visualization, more indicators, more stocks. But for now, we've got a good base to start with. So when you enter our website and you start on the dashboard, there's basically two places that you can access the trend scores. Under indicators, if you look in here, you see absolute and relative trend scores, which will take you to a page with those, and then you can see the sector summary. Okay. And then you can also, under like My Services, you can go to the BackTest engine, and then you can access the trend scores under the indicators page. So let's just quickly jump over there. Once you're on this ribbon here, you just click on the indicators, and then you just scroll down and you'll see the absolute and relative trend scores. Okay, so let's talk about what we're doing here. If you click on the indicator description, you're going to see these composite trend model scoring methodologies. These are very straightforward. Did ABC close above its 50-day? If it did, you get a score of +1. If it closed above its 100-day, another score of +1. If it closed above its 200-day, +1. And so we go on down the line. We've got 10 components for the absolute and 10 components for the relative. They're all the same concepts in terms of trend following. The only one that's a little bit tricky to understand is the 63-day breakout. The way that works is if the stock breaks out to a 63-day high on a closing basis, it goes to +1 until it closes at a 63-day low, and then in that case, it goes to 0, the count. So a very simple concept, a mix of sort of medium to long-term indicators. For me, the shorter in duration you go, the more trades you have, the greater the chance that you have a lot of whipsaw signal, especially in choppy environments. So the idea was to use sort of a medium to long-term methodology to capture big trends. And the unique thing about this as well is that even though this is, looking for big trends, we have those 5-day net change score changes that can actually identify swing trades over the short term. So a methodology here that's weighted the evidence, which we talk about a lot, that can capture big trends and then also identify swing trades coming out of, say, lows. So I encourage you to read, what we have in here, and
yeah, Dean, if I could jump in for 1 second, if you go back to that for just 1 second, just to summarize, a trend score for a given index or stock or whatever, it basically tells you the current strength of the trend for that stock. So obviously, something that's got a 10 has been performing better than something that's showing a 5. And then the relative trend score is how it's doing relative to the overall market. So once you find something that looks interesting, then you can say, well, also, how is it doing against the market? Because usually you want to try to find something that's doing a little better. Okay,
correct.
Back to you.
And we score on a relative basis. Everything is scored relative to the S&P 500. Right. That's the most widely followed benchmark in the world, and that's how we do it there. Okay, so let's go. All right, so when you come into this page, we have it organized by sort of category, we have these folders. And so we've got all the stocks for the S&P 1500, which obviously includes the 500, 400, and 600. So you've got small, medium, and large cap stocks. We also have a folder just for the S&P 500, the NASDAQ 100, domestic ETFs, foreign ETFs, other assets. This is where you'll find things like Bitcoin or crude oil or other indices. And then we have our sector summary. Let's click on the NASDAQ 100. Important to note, we have the sector here. So if you want to sort by the sector, you can do that. You can then sort relative trend score, sort back on the sector. And now we can see Netflix has a trend score of 10, relative trend score 10, and you can see these sorted on down from high to low according to the sector. And we'll dive into this in later in the presentation, but generally speaking, scores of 8 or higher are favorable, and then scores of 2 or lower are unfavorable. When it comes to the 5-day score changes, we want to see score changes of either 4 to 5 points for bullish swing trades up, and then obviously negative 4 to 5 for bullish or for bearish swing trades down. Now, for each one of these, you can then obviously dive in and see what the actual conditions are for an individual stock. So if we click on trend conditions, we're now going to see all the trend conditions for the absolute score. So for this instance here, like Adobe, it has a trend score of 1, and you can see a 0 represents a negative condition, a 1 represents a positive condition. And what you see here is that, for instance, Adobe is below its 50-day average, which means it has a trend condition of 0. It's below its 100-day average. It's below its 200-day average. And so you get an idea of which components are either positive or negative for the trend score by clicking on this subfolder. We can also do the same thing. We have a subfolder for the relative trend conditions. So if we click on those, relative trend conditions, the same thing here. Is the relative ratio above or below its 50-day average? If it's above its 50 average, it gets a score of 1. If it's below the 50-day average, it gets a score of 0. And then again, we compile those scores up into a composite ranging from 0 weakest to 10 strongest. Okay, and then the final subfolder here is what we call other trend indicators. Within this folder, and we'll add some more, but in here, what we see is we have our trend scores, our 5-day net changes. We have some other trend score indications here. So days greater than or equal to 8. And what you can do is sort by that, and then you can see, oh, well, look, Costco has been above a trend score of 8 for 267 consecutive days. We can do the same thing in terms of that relative trend, and we can sort that, and we can see Cintas has been above its, has a relative trend score of 8 or greater for 89 consecutive days. Now, why is this important? Well, one, we can first use it, in terms of the relative trend score to see what has broken above the 8 score or higher. And then you can scroll down, and then we can see, for example, here. Oh, hold on. We see Datadog. So Datadog just one day broke above a score of 8. However, what we do see here is its relative trend score is still a 5. So let's just click on Datadog here real quick. What's important with these consecutive counts is it provides you with an idea, right? So a perfect example is PayPal, right? PayPal had a relative trend score below 8 of 619 days. So if you saw that in here, you might say, all right, well, boy, that seems like an extended downtrend in PayPal. Let's keep an eye on PayPal and see if it, is basing out or turns up, and we see that relative trend score go above 8, and we see that trend score go above 8, and that may provide us with, a trading idea.
Right. In the meantime, while that's loading, just to kind of go back to the bigger picture, to be honest, a lot of the most successful traders and investors that I've known, their focus is buying strong stocks in strong sectors. You find something that's just breaking out, just making a new high, and leading the market and its sector. That's where you find really powerful moves, and that's basically what these tools are designed to do. If you find something with a trend score of 10 and a relative score strength of 10, that doesn't mean it's going to keep going. Probably means it's already been moving for a while, but finding those kinds of opportunities and those kinds of trends as they're starting to break is a huge advantage to people who really are looking to maximize in the market. Plus, the other reason for using these kinds of tools is we all have to decide what to buy and sell. In other words, we can't buy every stock, so we have to allocate, and going with strength is a really powerful tool. Okay,
Yeah.
Dean, back to you.
Okay, here. So we've got PayPal loaded up here, and you know what I wanted to highlight here is what you can see is the trend score turned down, you know, fell below 8 back in 2021, and then remained there for 619 days. However, now what we see is that both the trend score and the relative trend score have turned up and exceeded the level of 8, which is our favorable condition. And that generated a buy signal if you just used a simple process of saying, if both the trend score and the relative trend score exceed 8, let's go long PayPal. And that provided you here with, you know, a scenario where the stock had been in a downtrend, now it's turning up. If you ever, you know, if you followed some of these long-term trend following analysts out there, you know, you can see that, you know, you have a downtrend and then you have a basing process and then you turn up. So, and this provides us with the ability to identify trading ideas. Here, let's come off of this. Okay. All right. So PayPal. Let's discuss the sector summary here real quick. So what this does is just summarize each sector. There's 11 sectors in here, and then what it does is it summarizes those individual stocks within that. So if we sort by trend score, what we can see is that financials have 87.5% of the stocks with a trend score of 8 or higher. On the flip side, we see healthcare is very weak. Healthcare only has 29.51% of its stocks with a score of 8 or higher. We can also look at the relative score, and what we see here is financials with 56.94% of their stocks in that sector with a relative trend score of 8 or higher. And then we have a column here which is trend and relative trend of 8. This looks for trend score and relative combined 8 or higher. What we can see is financials leading the pack, healthcare. So why does this matter? When you're trend following, momentum investing, it always helps to sort of have that tailwind, right? The wind at your back. And so if we see that, you know, a stock in the financial sector has just triggered a new buy signal, you know, what we want to do is see, well, is this sort of just a one-off instance within the sector, or is there a major theme going on in the sector?
Right.
And
If I could jump back in, Dean.
yeah,
So another thing is it can sometimes give you some courage, because sometimes what you'll find is when in a sector or stocks in a sector start doing well, by the time you notice them, they've already rallied pretty sharply. If you're looking at a trend following basis, and these kinds of numbers can give you the information that you need to say, yes, they've been up a lot, but it's not too late. In other words, if they continue to show that strength on their own and relative to the market, buying and riding an uptrend, it's kind of like taking the train and moving in the right direction versus hoping the one coming the other way is going to turn around. You know, you want to find what's going to move as quickly as possible, and usually it's something that's already moving in that direction.
correct. Okay, so a couple more, you know, just points I want to make in here is one, backtest this indicator. This is a link here that will take you to the backtest engine. So if we wanted to test Adobe's relative or trend score in the backtest engine, all you have to do is click this link, and then it'll load up Adobe and it defaults to the trend score, but it's very easy to add the relative trend score. So that's an easy way for you to navigate from the indicators page with these scores to the backtest engine. Also, you can add these as favorites. So if you just click on the little star here, and eventually we will have a folder in here that'll be your favorites folder, where then you can add those. And then also in our nightly digest, if you add that as a favorite, you'll be able to see the trend scores in there. This is still a work in progress, but we plan to add this. That way, if you have, a portfolio, or if you have a watch list, whatever it may be, and you want to keep an eye on these, you can have a favorites folder, and then you can get that email at night, and it'll provide you with some detail in terms of what's going on with the trend scores. Okay, so I'm going to head back to the flip book, and before we look at some real world examples, I just wanted to highlight some things in terms of relative trend scores, and where we should be fishing. What pond should we be fishing? How should we be using these in terms of stocks, sectors, and groups within the market? So I'm going to flip here. All right, so this table is what I created using the S&P 500 sectors. The data goes back to 1957. And what I wanted to do was show you the percentage of time that each sector had a relative trend score of 8 or higher in cyclical upswings in the stock market since 1957. Okay, so these cyclical upswings occurred, either after a bear market or a significant growth scare correction where the market was down 15, 20%. And what I wanted to show is what typically leads, what typically trends on a relative basis compared to the market. And so what we can see here is technology and consumer discretionary are two of the best sectors. Now, those are growth sectors. So the stocks within those sectors are predominantly growth stocks. That means they have high growth in terms of earnings and revenue. And you can see that since 1957, the technology sector has had 11 times in all these cyclical upswings where it's had 50% of those days with a trend score of 8 or higher. And just to show you, even, we know over the last 30 years, well, it's been a growth-oriented market predominantly. I mean, obviously you had the value commodity period from 03 to 07, but generally speaking, from, sort of 90 to current day, it's really been dominated by growth stocks. But even pre-1991, if we look at those times when technology had 50% or more of the days with a relative trend score of 8 or higher, we saw that it was 5 times in these cyclical upswings. And that was actually tied for second with staples, and discretionary was 7. So the point I want to make here is that in these cyclical upswings, growth stocks typically have outperformed throughout history. And so that's where we want to be fishing. If we're going to use our relative and trend scores, and we're going to identify periods when the market's these stocks are going up and they're outperforming on a relative basis, we want to be fishing in that pond, the growth stock pond. Now, that doesn't mean there aren't going to be stocks that are in the value pool or the defensive pool that aren't going to be outperform and not going to have relative and absolute trend scores of 10, and you can't make money in it. It just means that from a big picture perspective, the tailwind is traditionally in these growth stock sectors. Okay. All right. So let's take a look at the next clip. This is just sort of a differentiated view. And what I did here I looked at any time each sector had a trend and relative trend score of 8 or higher. This is irregardless of the market environment. So this is bull and bear markets. And but what I looked at was is trend score of 8 combined with a relative trend score of 8. And then we calculated what the annualized returns were when those combined were together. And what we see, I have it sorted in this first column, 8 or higher, annualized returns, technology was 16.4, communications was 16, and then you go on down the line. But what you notice here is, this is since 1957, it's tech, communications, discretionary. These are all growth and defensive growth sectors with the highest annual returns when you have this combination of 8 or higher in terms of the trend and relative trend score. And if you scroll down, what you see here is these value, more cyclical oriented, have a lower score. So what does that mean? Well, what that means is they don't do well once they get up to a score of 8 or higher. What that means is these sectors are predominantly better for mean reversion, okay? 2015-16, right, is a great example. You know, you had, I don't know, 15% correction in the stock market, but if you went and you looked at like energy stocks, material stocks, gold stocks, they got slaughtered. They had been in downtrends for quite a while. Well, what happened? They had massive mean reversion rallies, you know, where stocks were going up 200 or 300% when the S&P 500 is, you know, up 15-20% coming out of that low. So when you're setting up, or you know, you're creating systems to use these relative and you know, trend scores composites, you need to keep in mind, you know, what pool are we fishing in, right? Are we going to fish in the growth pool where it's favorable to own momentum, or are we going to be in the value sort of cyclical where, you know, we want to employ more mean reversion? And that gets back to the point where I said, well, you know, has something been in a relative downtrend for a number of consecutive days, or is it seen a trend score that's been below 8 for a number of consecutive days? You know, this is important to know when you're thinking about, you know, how we use these. Down here, we've got, this is a repeat table here, but what I did was I looked at times when the trend and relative trend score are 2 or less, according to the sectors, and then calculated the annualized return for those. Well, what you see here is, right, you see almost the complete opposite. You see stuff like energy, materials, industrials with high annualized returns. And then when you're down here, you see the growth stocks, right, communications, technology, with low annualized returns. So, you know, what that tells you is that, you know, these value sort of cyclical areas do better when they're down and out, and they have these big rallies. But then once the trend gets established, they typically don't persist. So just an important thing to think about when, you know, when we're examining and setting up systems and trades for using these new indicators. Okay, so let's go back and let's take a look at a couple of real world examples of how we can use these. And there's two predominantly main ways that, let me hit refresh here. There's two predominantly ways that you can use these, right? You can use them for a trading signal, or you can use them in more of a systems approach, okay? And so let's take a look. What happened? Let me go back to my favorites. Let's take a look at the first, which would be sort of a signal approach. With the signal approach, we're going to use that 5-day trend score. And so what I've done is I've set up the 5-day trend score for the NASDAQ Composite, which goes back to 1972. I want to emphasize, when we see these trend score changes, you typically want to see a score of 4 or greater over that 5 days. So an increase of 4 or greater over a 5-day period to kick off what would be a trading signal or a swing trade. So let's take a look and see how we can set this up. Okay. Sorry, my internet's a little bit slow, so let's see if this will. Yeah, here we go. So, like I said, we've got the NASDAQ Composite as our symbol. Within here, our first condition would be the NASDAQ Composite trend score. And then in the indicator value, we can change this to a net change. And then we're going to use a 5-day period. And then what we're going to do is use a cross above 3.99, which would indicate a 5-day trend score change of 4 or greater. One secondary condition that I always put in with the trend scores is either, and I've showed this with the Bitcoin the other day in my research note, is either a breakout, a short-term breakout in price, or a positive rate of change. Now, why do we do this? Because with long-term trend, whether it's either the trend score or the relative trend score, when you use long-term measures, and especially when there's components with rising in-day moving averages, a lot of times what you can happen is you can see those long-term trend scores might jump up, but there's short-term deterioration in price. So what this does by having this second layer is ensure that we have the high trend or the high relative trend score, but we're also seeing some positive short-term price momentum. And that typically, what it means is that it means that you may buy a little bit higher, but it also means that if something were to deteriorate, you're not buying into a falling knife. So what I do with this signal here is I just add a 10-day rate of change. And all I do is say is the 10-day rate of change has to be positive, okay? And our 5-day net change for the trend score for the NASDAQ Composite has to jump 4 or greater, and that has to occur on the same bar. Now I'm going to use a time in market of 63 days, and I'll use a stop loss of 5%, okay? So if we go back up and we take a look at our results, what we can see here is that we had 33 trades, 25 were positive, 8 were negative, for a 75.76% win rate. That's just holding for 63 days. There's a lot of other ways that we could exit before that 63-day period. We could use, a profit target. We can say, well, if it goes up 10, 15, 20%, exit. The BackTest engine, allows you multiple conditions. So we can use all kinds of other exit conditions. But for today, I just wanted to show you that, here's the potential. Now, look, our average win was 10%. Our average loss was 5%, which is basically what our stop loss was. So if we look at our total trades, what we see here is that all these negative 4.99% is our stop loss, right? And you can see that for the exit reason. And out of the 8 losses that we have, all of those were instances where we got stopped out. Otherwise, it went up for 63 straight days. What we can see is if we look at different time frame metrics here in terms of the exit criteria, you can see 2 weeks later, it was up 73% of the time. A month later, 70%. 2 months, 76%. And then 82% over that 42 days. Over the 3 months. So, and interesting enough, a year later, the NASDAQ Composite was up 88% of the time. And obviously we see good Z-scores here, above 2. We see favorable gains relative to losses. So this is a good signal. What I would suggest is this is a trade, but these
Dean,
net change signals can also turn into a core position. Yes, Jay.
If you can go back to summary.
Sure.
And scroll back down to that equity curve.
Yeah.
For me, it's the old picture's worth 1,000 words. We all want to see positive numbers in the end, but the other question in the real world is how much of a decline do you have to sit through on any given trade? Because everybody knows if it gets to be too big, at some point, there's a risk you're going to either pull the plug prematurely or your reasonable stop loss will get hit. So this chart, to me, this is the beautiful illustration of what I call LLUR, lower left to upper right. You really, when you put everything aside, whatever it is you're looking at, when you look at a chart like this, that's what you want to see is consistency to the upside. And when it does go down, it's not a huge drop off. So I just wanted to add that in.
Yep, no, that's great. You know, this is the NASDAQ Composite. I mean, this is a high octane, you know, growth driven type of index. And this equity curve, these statistics look good. If you go and apply this to utility stocks or, you know, some other sort of, you know, those other sectors that we showed, you know, you're not going to get the same results. So, you know, the idea here is you know, you need to make sure you know, that, you know, you want these higher beta, these growth stocks, you know, that have higher average daily ranges. That's the pool that we want to be fishing in when we're using these types of indicators. So, you know, a great example is you know, within the BackTest engine, you could take this and, you know, the NASDAQ 100 is a pretty good growth oriented, tech driven. It's got consumer discretionary, it's got other sectors. But you could go in, you could set this signal up for 50 or all 100 of those. And then each night, you know, you could click your find last signal button and it could show you that, oh, wait, you know, something just triggered. So that's it's very easy to set up and then monitor. There's a lot of flexibility in terms of, you know, how you can use this in terms of jittering those signals, how you can, you know, use exit rules and what have you. So that's an example of a 5-day net change trend score trading signal. Let's take a look at the Bitcoin example that you know, that if you didn't have a chance to read my note, I think that was last week that I published a note, a buy signal using the trend score and relative trend score indicators for Bitcoin. So let's go take a look at that. This one is the one I mentioned in my note. Very easy. You know, we're going to use Bitcoin trend condition. We're looking for instances when the trend score is 8 or higher. You know, then I did add in one additional condition for this, and this condition requires the 5-day net change to be greater than 0. The reason why I did that is what this ensures is that trend score is moving up, that it's not deteriorating. So that's one new condition I did add that was not in the note. I use that for stocks. We want to make sure everything is moving in this direction when we get a signal. Here's our relative trend score greater than 8, and then that final condition, which was basically just a 10-day high. Again, ensuring that everything is moving upwards when we get that trading signal. And then from an exit criteria perspective, very easy. We set up relative trend score cross below 5, or we see trend score cross below 5. In both those cases, you're out of Bitcoin. And again, let's go up. We'll just kind of take a look at the chart here, and we can see we've got all of our indicators in here. And then we can get sort of a long-term view of these Bitcoin signals. Let me change this to log. Okay. What you can see here is again, green arrows means it's a buy, red, it means it's a sell. And you know, what you can just sort of get a general sense is gosh, what is this acting funny? Is that, you know, we're catching these big upswings in Bitcoin. We're letting that trend persist. It may not persist for long. It might be 20 days, it might be 30 days, or it might be a year. That's the thing about trend following is you never know how long that trend will persist up or persist down. So let's just go back down here and we'll look at these statistics, which, you know, I highlighted in the note, but let's see here, go back to results. The results are good. You know, obviously, anytime you catch a big upswing in Bitcoin, you know, we see a 70% win rate, 7 winners, 3 losers. You know, this one I didn't use a stop loss in here, but I don't think I did. Let me make sure I didn't. Yeah. So with Bitcoin, you probably want to put a stop loss in there, right? These were all just, you know, met the criteria, but but you could use that exit with different time frames. I mean, you can see 3 months later, it was up 89% of the time. This is a system, but you could also just use it to generate one-off trades and then manage that process different than, say, using the trend scores as your exit criteria. I mean, if it goes up 89% of the time, that's pretty good over a 3-month period. One thing to keep in mind, we had a client, mentioned the Z-scores, and here's the thing about Bitcoin and Z-scores. They're not going to look good, okay? Because if you go back and you look at those 3-month rolling returns or 6-month rolling returns from 2010 to 2013, when Bitcoin was in the early stages, it was just emerging as an asset. It's going from a penny to, $1. Those rolling returns were massive. Okay. I think I looked at the 3-month rolling return, and at one point you had a 3-month rolling return of 3,200%. Well, when you start comparing all these signals, in terms of that Z-score, on a go-forward basis from 2013 forward, your signals aren't going to look good. So, point is I told the subscriber, look, just kind of generally ignore those. What we want to know is do we have a good win rate? Is this in an uptrend? And if so, let's be a buyer. Okay. You need to temper I've mentioned this in notes before. You need to temper your expectations in terms of Bitcoin. Okay. The historical data looks good here. Okay. But you're not going to get the same returns. Okay.
Dean, if I can jump in. Yeah. So one thing with Bitcoin is it's really easy to fill your eyes with stars, like, oh my God, I could make 10,000% in a year. Maybe, I don't know, but it's really important to have realistic expectations on the way in, whether it's Bitcoin or anything else. And 2 points I wanted to make, systems aside, just trading in general, is it's real important to determine ahead of time position size. In other words, how much of your capital are you going to commit to any one trade? So my concern with looking at these numbers is somebody said, boy, I'm going to just put it all in Bitcoin on this one trade, and don't do that. That's how people go belly up in this business. So, whether it's 1% of your capital or 8% or something in between, it's really important to have an idea of how much you're going to commit and to kind of stick with that from trade to trade. The other thing about trend following that I found, more on a shorter term trading basis, but if I can buy, let's say, 200 shares of something rather than 100 shares, if that fits within my position sizing, the first big move, I might say, all right, I'm going to sell half that position or some part of that position to kind of lock in a profit. Because another fear, again, whatever strategy you're talking about aside, psychologically, when you get a big win and all of a sudden it turns into a loss again, that makes it hard to go back the next time. So just put that kind of in the back of your head. If you have a decent size position and you get a good move and you got a great profit, sell a part of it and lock in some of that profit. And then eventually you're going to kick yourself either way, because if it goes down, you'll say, well, I should have sold it all. And if it keeps going up, you'll say, well, I shouldn't have listened to that guy on that webinar. I should have just held on. But I found that to be very beneficial over the years. Back to you.
Yeah. So, look, I worked for a growth manager for 20 plus years. At one point we had 35 billion under management. And, we would cap positions at 5%. Now, we'd let them run. If they got to 7% of the portfolio, then you trim it back to 5%. So if you were using the, the relative, absolute and relative trend scores in a systematic approach, and let's just say, we were going to hone in on the NASDAQ 100 stocks. There's 100 stocks in there. Ideally, you'd probably want to own maybe 20 to 30 if they were on a buy signal. So you may have 2 to 4% type positions. So that if something happens and one of these companies, announces poor earnings, well, if it's only a 2% position, it gaps down big, you're not going to get burned. Okay. And then same thing as Jay mentioned with Bitcoin. I mean, I trade in and out of Bitcoin, but, I never have more than 2 or 3% of my portfolio in the Bitcoin ETF. Okay. So, I know there are traders out there who take, bigger positions, but they're trading, right? If you're more of an investor, right, and you're going to use an approach of holding, 10, 15, 20 stocks in your portfolio, you don't want to let one or two of those positions, grow to be significantly larger than all the others, especially when it comes to momentum investing. Okay. Because at the end of the day, eventually, eventually one of these days we're going to see it, NVIDIA is going to say, well, there's no more demand for our chips. And, it's going to gap down 20 to 30% overnight, and if that's a 10% position in your portfolio, you're going to feel the pain. So prudent money management is always advised. Okay. So that's, two examples, sort of a trend change signal or, swing trading, and then obviously more of a systematic approach where we're using both the trend scores to try and identify big uptrends in stocks. None of this works if you don't have the discipline to carry out your rules. Okay, it's very, very important. All right, so we've got about 12 minutes to go here, so we're gonna flip back to some of our questions that we got from subscribers, and we'll answer those. And then we're gonna Jay and I will each kind of throw our 2 cents in on where we stand in terms of our market thoughts. So let's just kind of go here. And all right, how to best use these trend indicators? Well, I think we covered that pretty well. If you have more questions, please shoot an email. After the webinar, please shoot an email to admin@Sentiment Trader, and we'll do our best to respond to those here quickly. Make a back test. I think kind of showed everyone with the Bitcoin and the net change example of how you go about setting up those back tests. All those trend and relative trend scores are in there. So if you're going to make one, you just simply type in the symbol, right? So you might type in AAPL for Apple, and then you would just type TRE, and then you'll see it pop up, Apple Trend Score. Or you might put in the symbol Apple, and then you might type REL, and then all of a sudden you'll see relative trend score pop up. So pretty easy to make those. We'll if people have questions, we can show you further. Can you participate in a seasonal play, specifically IWM, if you missed the entry date buying on a slight pullback? Jay, you want to take that one?
Sure. The answer is absolutely yes. Any seasonal, if you look at any of our seasonal charts, and obviously I look at them a lot, and I do that because, in my words, they tell me when to look where, help me to zero in on potential opportunities, but no seasonal trend is ever 100%. And so it's not necessarily buy on one specific date and sell on the next, whatever the next specific date is. It's, let's say, whatever it is, Bitcoin has been in a huge seasonal uptrend. If you look at the Bitcoin seasonal chart, you would not be surprised at what the market's doing right now. And that wasn't guaranteed, but what it tells me is if price trend and seasonality agree, that's a terrific opportunity. And a lot of times I don't even wait for a pullback, in all candor. If those two align, I'll jump in and place a stop loss, etc.
Yeah.
So,
yeah.
yes.
So this is great because Jay's got all these seasonality studies. Now you can combine it with the trend score, and so you can see, okay, well, yep, seasonality looks good. Oh, and by the way, it's got a trend score of 10, and it's got a relative trend score of this. Just one comment though regarding IWM, which is the Russell 2000. It's not a great index in terms of the trend score, relative trend score, systematic approach. It's just, you're better off identifying individual stocks within the Russell 2000 to go after and play momentum versus just playing the broad index. It's just very choppy. A trend following system would just get eaten up. But what you could do is use those the net change score. And when you see the market correct, right? So we have a gross scale correction or big bear market, use that to identify a trade in the Russell 2000 coming out of, say, a bear market. because as we know over time, over history, Russell 2000 has outperformed initial stages of a bull market. Okay, those smaller companies just tend to do better coming out of bear markets. But then once that sort of initial period's over, they're not going to trend. The Russell 2000 index will not trend. All right, could you include your discussion in the indicator known as the ARMS or trend? I don't really, I'll make my 2 cents, Jay. Honestly, I don't really follow trend, the ARMS, that much anymore, okay? What this indicator looks at is the amount of volume in down stocks relative to the amount of volume in up stocks. A low reading would be 0.5. That typically is bullish. A high reading of 0.2, 0.3 is bearish, where you'd go counter trend. But here's my knock, is that there's a lot of stocks, big stocks, which we know, that trade a lot of volume. So what my point is you're not getting a real sort of perspective on volume across a broad spectrum of stocks. You got 10 stocks that are trading, 800 million shares a day, and there's 2 billion. Let's say there's 2 billion traded on the NYSE, and out of that 2 billion, there's 800 million in 7 stocks. Well, that's not giving you a really good perspective in terms of what is going on in terms of volume flow across the entire market. So I don't really, it used to be a good indicator and I used to follow it, but what we've gotten to is a point where it's just not as valuable, in my opinion, as it used to be. And you saw this back in 2008 too, right? So in the bear market, the global financial crisis, there was so much volume flowing in and out of the bank stocks, right? That the ARMS was just a view of what the bank stocks were doing. It wasn't a view of what the broad market was doing. So Jay, your 2 cents were.
Pretty much agreed. There was a time, I hate to use the phrase, back in the day when a 10-day moving average of trend of 1.5 was almost the holy grail. There were bear market bottoms that met almost to the day of that kind of a reading. And we just haven't seen that. And for reasons that Dean explained, just the way the volume breaks out now among these bigger stocks, it seems to have thrown it off. Maybe we'll take another look at that one sometime soon. But it just doesn't quite seem to have the same meaning as it did.
Yeah. Okay. And then sort of final question here. From time to time, Dean and Jay provide specific trading ideas. We could possibly provide more. Well, that's the intent here with the trend scores, is that we're going to be able to identify more single stock ETF ideas in a systematic approach, and then we can mention those in research notes. And what we'll probably do is have another service specifically tied to just sending out recommendations based upon the trend scores. That may be in our Essentials Plus package. We need to discuss that further, but it's coming. Like I said in my opening statement, this is feedback from clients over the years has been, you guys do an excellent job of giving us that big, broad macro view, but there's not enough, attention in terms of idea generation for single stocks and ETFs. This should help address that.
Yeah, one thing I would add, Dean, is, I always tell people we are analysts, not advisors. And also the fact is, I think, Dean, probably the same for you. What I've learned, whatever success I've had as an investor and a trader, has come from developing my own approach, good, bad, or otherwise. At times, I've taken everything that I've found over the last umpteen years and kind of boiled it down to what I find useful. And most successful investors that I know have done the same thing. And so that's really our goal, is to help you as the user to find what works for you, because not everybody uses the same thing, obviously, and not the same thing works for everybody. So that's really our goal, and we do try to get as specific as we can in terms of ideas in our daily notes. If I put out a bullish piece on something, that means I'm bullish on that market and I'm looking to trade it from the long side. But in terms of the actual entry and exit, at this point, as Dean said, that might be something that we'll do separately, but it's not where we're at right now.
Yeah. Again, this is, just to summarize, this is momentum style investing. And as Jay said, that's not for everyone. This is for people that want growth in their portfolio. If you're nearing retirement and you need yield, this is not for you. So I would, as Jay said, you need to have a style, a risk tolerance that is suitable for you and where you are in terms of retirement and all that. If you have a really long runway, you probably want growth. If you don't have a long runway in terms of retirement, then you want yield and income.
Dean, I actually want to amend that. For somebody close to retirement, it could be for you as long as you use only a certain amount of your capital. In other words, if you take, I don't know what the magic number is, but I'm going to say 10%. If you take 10% of your assets and you say, I think I can do this, I think I can trade successfully using momentum, there's nothing wrong with that. But if you start getting into high risk trading with 70 or 80% of your retirement money, that's what Dean is talking about. You don't want to do that. But whatever works for you, that's what you need to find. And then you just have to allocate the right amount of capital.
That sort of just wraps things up for today. I just want to thank everyone for attending the webinar. If you have any questions regarding the trend scores, just shoot an email to admin@sentimenttrader.com, and we'll do our best to get back to you as quickly as possible. I want to just reiterate, if you're a new subscriber, we have a lot of information in terms of what's on our website. A lot of times people get sort of lost. So please, I would encourage you to watch those former webinar videos where we do more of a walkthrough in terms of the website and what Jay and I use, and the best way to navigate the website to get the best out of it. Our next webinar is going to be December the 11th at 11 a.m. Eastern, and Jay will be taking the lead on that, but I will also be attending. Jay, anything final thoughts from? Oh, you know what? Quickly, let's just touch on sort of market outlook. Generally, I remain bullish, even despite the fact that we had the risk-off composite model signal. As I showed in that note, it's predominantly the weakness that we're seeing in market breadth is coming from staples and healthcare, energy and materials. It's not coming from those key cyclical areas like financials, industrials, consumer discretionary. I will say, just in the last few days, tech has weakened a little bit in terms of the market breadth, but it's not too alarming. So generally speaking, I remain constructive on the market. But look, we've come a long way. There's a lot of open questions out there in terms of what's going to happen next year with the new administration. Keep an eye on interest rates. I pointed that out in my note from my risk-off note on Monday. When that risk-off signal failed last time, well, it failed because interest rates dropped big time, right? And that was a critical factor for the stock market. It took off. If we don't see interest rates, drop here and they stay sort of elevated, we may spend more time here just kind of going sideways and really doing nothing here. Maybe at some point, the seasonality will kick in, And you know, I think we'll probably see an additional leg up. But so, you know, for right now, I'm cautiously optimistic in terms of the market, but really keeping an eye on interest rates for now. Jay?
Yeah, so I'll just make it brief and tie it all back to trend following and the potential benefits of trend following. If you think of the last couple of years, if you were a serious trend follower, you've probably made a lot of money in the stock market. You've probably made some good money in the last year in gold. Recently, you've been doing very well in Bitcoin, and you've avoided a lot of pain in the bear market, or I'm sorry, in the bond market, which has been in a bear market for over 4 years now. So those four things just highlight the potential benefits of really focusing in on trend following.
Great. All right. Well, that's a wrap. Thank you. And we'll see you on December the 11th.
Very good. Thank you. Thanks for joining us.